One popular token, Terra Luna, lost 99%.
The collapse of Three Arrows Capital.
Celsius has frozen its...
Voyager Digital files for Chapter 11 bankruptcy protection.
Sam Bankman-Fried faces bankruptcy. BlockFi has now filed for bankruptcy, the latest casualty in the crypto turmoil after FTX's collapse.
What you just saw here is the great crypto crisis. And as you could clearly see, the collapse of FTX is not some isolated incident. It is part of a bigger story. A story that is all about speculation, debt, and what economists call contagion. And while the story is shaking the crypto industry to its very core, the media has mostly focused on the individual scandals of people like Sam Bankman-Fried and not the bigger picture. So to get you up to speed, here's everything you need to know about crypto's great financial crisis. Crypto's great financial crisis started in the summer of 2022 with the fall of crypto hedge fund Three Arrows Capital. It was just half a year earlier that the founders of Three Arrow Capital, Kyle Davies and Zhu Zhu, were on top of the world. At a relatively young age, their fund already made billions investing in crypto projects such as Ethereum, Luna, the Grayscale Trust and BlockFi. No wonder that they were widely considered crypto geniuses. Being a hedge fund, Three Arrows Capital had mostly funded these investments with money from shareholders, including its founders. As the value of their crypto investments kept going up, so did the value of their fund. Indeed, the founders of Three Arrows had discovered an age-old secret to quick financial success: leverage. Now, leverage sounds like a difficult concept, but all that it means is that besides having shareholders to fund your investments, you also have borrowed some money. This practice is called leverage because just like how a lever in real life can amplify your physical strength, leverage in finance can amplify your financial strength. However, as Mr. Davies and Zhu soon discovered, leveraging your investment is a double-edged sword. Sure, when asset prices went up, Mr. Davies and Zhu looked like geniuses, receiving favorable press coverage, gaining a massive Twitter following, and being generally considered the adults in the room. However, when crypto prices started going down, Mr. Davies and Zhu quickly saw themselves becoming crypto villains instead. Here's how that worked. Say that during a crypto rally, average crypto investments would double in value. Let's first look at a conservative, non-leveraged hedge fund, and let's call it Straight Arrow Capital. When its investments doubled in value, so did the claims of the shareholders on these investments. Now let's compare it to a risky leveraged hedge fund, and let's call it Four Arrows Capital. Borrowing money meant that it could invest twice as much in the market as Straight Arrow Capital. It therefore would have made twice as much money. But because debt claims are fixed, all of this growth now benefits the claims of the shareholders. So while the shareholders of Straight Arrow Capital doubled their investment, the shareholders of Four Arrows Capital almost quadrupled it. This is the awesome power of leverage. While the investment strategy of both funds is exactly the same, the leaders of Four Arrow Capital look like geniuses compared to their boring counterparts at Straight Arrow Capital. And this is not exactly a new phenomena, because it is precisely what happened before the great financial crisis of 2008. I think that Steve Eisman, famous for the movie The Big Short, put it really well when he said,
"They thought they were making more money because it was them, but really what was happening is they were making more money because their institution was becoming more levered." And really what happened was they mistook leverage for genius.
And as we have seen, leverage also made the founders of Three Arrow Capital look like geniuses during the good times. However, in the early summer of 2022, the good times were long gone. Crypto prices had been falling for roughly 6 months. Now, Mr. Davies and Zhu were about to discover that leverage is a multiplier of profits as well as of losses. To understand why, let's go back to our two hypothetical hedge funds, and let's say that the investment portfolio that they had would now lose half of its value. For Straight Arrow Capital, the calculations remain simple. Now its investors lose half of their investment. However, the same price decrease has very different implications for the leveraged hedge fund. It had invested twice as much, and therefore it loses twice as much. But since the fund will still have to repay its borrowers in full, their shareholders lose their entire investment. Leverage multiplied their losses, and in this case it means that the leverage hedge fund 4 Arrows Capital will go broke, while Straight Arrow Capital is still standing. For Mr. Davies and Tsu, the moment of reckoning came when the value of one of their biggest investments, the Luna Terra tokens, plummeted to virtually zero. At the same time, they had to take some big losses on their investments in the Grayscale Bitcoin Trust. Now, the Grayscale losses and the Luna collapse cost a lot of investors dearly. However, for the highly leveraged 3 Arrows hedge fund, it cost them everything. So, eventually on July the 1st, they had to file for bankruptcy because they couldn't meet their lenders' demands, owing them more than $2.8 billion in unsecured claims. Similarly to the spectacular rise and fall of 3 Arrows Capital, Celsius Network LLC was founded by 3 rising stars in the crypto world. Mr. Alex Mashinsky, Daniel Leon, and a guy known as Nuke Goldstein. They promised a better way of banking in which customers would receive sky-high interest rates in return for depositing funds at their crypto bank. They claimed it would even be safer than a regular banking. And actually, during the crypto boom, they were right. By funding high-return projects like the 3 Arrows hedge fund, the founders could pay their depositors these sky-high returns while becoming fabulously wealthy and confident in the process. Perhaps the best illustration of this confidence is this video message that Daniel Nielsen posted on Twitter in 2021 addressing a legendary investor, Warren Buffett.
Warren. A few years back, you called Bitcoin rat poison squared, as if straight rat poison was not bad enough. Yesterday, the market cap of this rat poison squared passed the value of Berkshire. I guess that means one of two things. Either we were not rat poison after all, or Berkshire is not as valuable as rat poison squared.
Yeah, let's bring in the Big Short's Mr. Eisman again.
And really what happened was they mistook leverage for genius.
And indeed, given that customer deposits for a bank are basically debt, Celsius was in fact highly leveraged. Not surprisingly, the bank quickly collapsed when its risky investments started losing value as the crypto market plunged. But that is not where the story ended, because as it later turns out, both the fall of 3 Arrows and Celsius had already infected 2 other major crypto institutions, Voyager Digital and BlockFi, something that economists typically refer to as Contagion. But before getting into that serious business, let's talk about the sponsor of this video, Morning Brew. To be able to do better research for videos like this one, I like to stay up to date on the latest developments. Morning Brew helps me do so in a structured way. Morning Brew is a free daily newsletter delivered Mondays to Sundays that helps me get up to speed on the latest developments in business, finance and tech in just 5 minutes. Through a witty, relevant and informative reporting, Morning Brew makes topics that are sometimes densely and boringly delivered by traditional media come to life in an easily digestible format. Morning Brew even has its own crypto crash course to keep you up to date on the latest developments in the sector. So if you're interested in finance, business or tech and want to stay up to date through an entertaining daily update, I suggest you head over to morningbrewdaily.com/M&M or click the link in the description of this video to sign up to their newsletter. It's completely free and only takes 15 seconds to subscribe. Alright, back to how Voyager Digital and BlockFi were the first to get infected through Contagion. But first I want to emphasize that in theory, Contagion shouldn't affect a broker at all. You see, a broker is typically just an intermediary between people like you and me and an exchange like FTX or Binance. It doesn't borrow, it doesn't lend, it just helps to connect other people. However, BlockFi and Voyager were more ambitious, so besides them being a broker, they also had their little side hustle business as a bank. Just like Celsius, they allowed customers to deposit money at sky-high interest rates. At the same time, they would lend out money to trustworthy, totally not risky counterparties like 3 Arrows Capital. So when 3 Arrows defaulted on its loan, Voyager's and BlockFi's assets lost a ton of value, while their liabilities did not. Therefore, they were as good as bankrupt. Economists would say that they were a victim of direct contagion, because basically any leveraged firm that had lent directly to a distressed firm can potentially see their asset values drop below a crucial threshold at which it can no longer repay its own lenders. Luckily, direct contagion can be stopped, and this is where another golden boy, genius of crypto came in, Sam Friedman-Bank, the owner of FTX, who over the summer became known for his great crypto bailout. If we visualize FTX Bailout for BlockFi, you can see that by pouring enough money into their business, Mr. Friedman basically delevered BlockFi and therefore rescued it from bankruptcy. This meant that anyone who had lent to BlockFi was saved. Direct contagion was stopped. Sure, it was potentially a loss-making investment for FTX, but it could also quickly turn into a profit when the good times would return. However, focusing only on the direct links between these two firms underestimates the real risk of the crisis, given that we miss out on what economists call indirect contagion. Indirect contagion is much less talked about because it is more abstract than direct contagion, but that doesn't mean that it is less important. In fact, economists from the European Systemic Risk Board argue that indirect contagion was actually the key ingredient to understand the great financial crisis of 2007. And likewise, I argue that indirect contagion is the key ingredient if you want to understand the current crypto crisis. Okay, here's how it works. Let's go back to our Celsius example. Unlike Three Arrows, there was very limited direct contagion when Celsius collapsed. However, there was a ton of indirect contagion via asset prices. You see, Celsius had a lot of crypto assets, such as Bitcoin, and when it got into trouble, it quickly had to sell them, driving the price of Bitcoin further down. And remember, the real reason that crypto's leveraged golden boys turned from heroes to villains was that crypto prices started falling in the first place. So whenever a big player fell, there was indirect contagion because they had to sell their assets. This then further decreased crypto prices, and this in turn meant that other leveraged institutions were also no longer able to repay their borrowers, and this then reduced crypto crisis even more, and so on and so on. And while Mr. Friedman-Bank stopped direct contagion, he was only able to slow down indirect contagion. As summer turned to autumn, crypto prices kept going down. And this ultimately led to the downfall of FTX. Like BlockFi and Voyager had not just acted as a broker, Mr. Friedman's exchange had not just acted like an exchange. No, it also had to run a little Celsius-like banking business on the side by accepting deposits at high interest rates while making very risky investments. Now, on top of that, FTX had also invested funds that it promised would not be invested. And it did so by sending money to its sister company, Alameda Research, which was actually a hedge fund and not a research company. But anyway, Alameda Research took leveraging to the next level. You see, normally a hedge fund has to post some kind of collateral to the lender to secure a loan. Because if it cannot repay the loan, then the lender can still get the collateral and doesn't lose too much money. Alameda, however, thought it was smarter than the other hedge funds, and so to guarantee its borrowing and pay a lower interest rate, it used tokens issued by FTX as collateral. And that's very problematic because these two companies were basically the same. In other words, if Alameda is your right hand, it used collateral made up by your left hand to ensure borrowing by your right hand or something like that. Anyway, when CoinDesk informed the public about these dubious business practices, everyone tried to get their money out as quickly as possible. So just like with Celsius and BlockFi before it, FTX and Alameda then had a bank run. In other words, their wacky leverage had gotten the best of them, and soon they had to file for bankruptcy. The fall from grace of one of crypto's biggest geniuses who had embezzled customer money, well, the press loved a story like this. But I think that this is basically a huge distraction. Yeah, so what they did was really close to a fraudulent play on a leverage that is depending on rising asset prices. But it's still a leverage that is depending on rising asset prices, and that's the most important part of the story, not the fraud. because there are many, many more companies in the same position. Remember BlockFi? Well, without its backer, BlockFi quickly filed for bankruptcy on November the 28th. What's more, crypto lender Genesis reportedly lost $175 million in an FTX trading account. So direct contagion is clearly back. What's more, the collapse of FTX was followed by big drops in all major cryptocurrencies. So indirect contagion is also clearly back. In other words, what happened with FTX is that it had stopped contagion, but then FTX itself fell. And now let's see what we have remaining of the crypto industry. So indirect contagion is clearly also back. And this is why crypto lender Genesis is now reportedly close to bankruptcy, whereas direct contagion was manageable by it before. Now that indirect contagion is also out in full force, Genesis is now in big trouble. Which leads us to the question, who's next? Well, besides Genesis, hedge fund Grayscale is already in big trouble. It apparently did an audit of its reserves in what is known as a proof of reserves, but it doesn't want to share the results with the public due to security concerns. And that is a big deal because it reportedly owns around 3% of the world's Bitcoin supply. Bitcoins that will have to be sold if that hedge fund goes under. What's more, it could spark another big round of direct contagion because its parent company, the Digital Currency Group or DCG, owns many other companies like Genesis. And that is just the tip of the iceberg. Even companies that have submitted these proof of reserves are not in the clear. First of all, such proof of reserves can fairly easily be manipulated by temporarily borrowing assets for the audit. But what's more, thanks to Contagion, it could very well be that exchanges like Gemini and Binance that have also offered deposits at sky-high interest rates like Celsius, BlockFi and FTX have enough reserves today, but not tomorrow if crypto prices keep falling. Indeed, Gemini already had to stop withdrawals for some of their programs. And these are only the big names. There are also many, many more lesser-known firms that are also in big trouble. And this makes sense, right? We know that so many more firms use leverage to bet on rising crypto prices. And sure, the most leveraged firms are always the first ones to fall. But if Contagion continues and crypto prices keep dropping, eventually all leveraged crypto firms will have to fall, not just the fraudulent ones like FTX. So crypto contagion needs to be stopped. But can it be stopped? In other words, what's next? Well, let's talk about the possibility of ending or even reversing the contagion. For this to work, the sector basically needs another bailout. Remember how Sam Friedman Bank was able to hold the contagion last summer? Well, now his main competitor, CZ from Binance, is giving it a shot. He recently announced a $2 billion bailout plan for distressed crypto firms. And even though that sounds like a lot of money, this bailout wouldn't even have been enough to save a single firm like Three Arrows Capital, and so it's really unlikely to stop the contagion now. No, the best hope that the sector has, in my opinion, is that the US Federal Reserve will stop raising interest rates, or even better, that it would completely reverse course and stimulate the entire financial sector. But yeah, that doesn't look very likely at the moment. But okay then, what about decentralized finance? Almost all of the institutions that I talked about in this video are what crypto enthusiasts refer to as centralized finance or CeFi. These are controlled by a person or a group of persons, and therefore these can go broke and cause direct contagion. Decentralized finance, on the other hand, refers to algorithms that users can use to borrow money. But fundamentally, they also provide credit with the hope of rising asset prices. So they do contribute to indirect contagion. But since these algorithms cannot go broke, these loans can rapidly return as well. But in my opinion, it's most likely that crypto prices will fall by quite a lot more. How much more? Well, there's actually an economic theory that can help answer this question. And if you're interested in that, check out my video over here about the possible end of crypto. Alternatively, if you're intrigued by the details of decentralized finance, check out this in-depth interview over here with an engineer who worked on crypto lending algorithm Liquidity. I think this is more stable than the House of Cards though, right? Oh no.